Welcome back. When it comes to the stock market, you might be wondering if we are up or down so far this year, and more importantly, how it might impact you. Here with a closer look at the market, certified financial planner and president of Shakiba Capital, Trevor Shakiba, welcome to the show.
Thank you.
This is like speaking another language for so many people, and I remember when we hit 20,000, that was like revolutionary, right?
Yeah.
We're really at 29,000 right now.
29,000. We might actually be a little bit lower today because the market's down quite a bit. I think 200-300 points. There's some concern about the coronavirus, which is what we're going to talk about. But you know what I was thinking about 4 years ago when the election happened, the Dow was at 17,000.
Yeah.
And we're now at 29. So it's a good time right now to just pause, talk a little bit about it, what expectations should be, especially coming off last year.
All right, speaking of expectations, can we expect that things will continue to be as rosy as they have been lately? And a lot of people really are afraid that maybe a crash is looming with numbers so high they can only go down, maybe?
Down,
right?
up. I mean,
who knows?
Yeah, the truth is that no one knows, okay? But I will say this, it is unlikely for us to see another 30% this year. Last year was a great year. I think the S&P 500 was up almost 30%. So it's unlikely in an election year to see an additional return like that. The market hates uncertainty more than anything, and I highlighted the coronavirus,
right.
But also it's an election year, and historically election years have not been as good. We can't predict it, we can't time it, so I'm not advocating that you should think a crash is coming, but certainly be cautious here. I definitely want to put that out there.
The market does not like uncertainty, as you mentioned, and in an election year and with a global health crisis, there could be a correction coming. So how likely is a correction around the corner?
Yeah, you know, the thing about a correction, which is very different than a crash, a correction is defined by a 10% pullback or more. What I said here is that it's likely. And the reason it's likely is because we've seen a 10% pullback or more almost every year, on average every 15 months, going back to 1980. And it's been around 14%. So we should not be surprised at all to see a 10% pullback this year. Again, the Dow is at 29,000 after coming off a year where we basically went straight up. Have your expectations. Make sure you're ready for that.
I'm guessing that a lot of our viewers out there might not be investing constantly, watching the market every single day. But for those people out there who maybe do have investments that they pay casual attention to, what should we do in a case like this?
Well, I think the first thing is that you should take a good look at where your investment portfolio is. And that doesn't mean that you have millions of dollars. Take a look at your 401k. Is it up 30% coming off last year? And don't just leave it. Now is actually the time to do what we call rebalancing. And the reason you would want to do that is because things in the portfolio have done so well, you might be out of whack a little bit. And so now would be the time to rebalance, getting back to the original allocation, which really aligns with your risk tolerance and your goals. A lot of people will say, hey, I'm up 30%.
Don't touch it.
Let it ride.
But you're saying strategize and leverage those numbers.
And rebalance back to the original allocation.
So there's no such thing, right, as timing the market, right? As you mentioned, nobody knows what's coming next. Nobody has a crystal ball. But there are two things you say that we can do to sort of increase our chances of being financially benefited from this.
Yeah, well, my point here is, you know, talking about the Dow at 29,000, a lot of people would be apt to sell a portion or all of their portfolio and wait. That is a loser's game. Timing the market is impossible. You've got to get two things right to effectively do that. When to get out, but also when to get back in, and everyone forgets about that. And when to get back in is very, very difficult. So timing the market should be out. The thing that you can really do here is just consistently save in or dollar cost average. That'll spread your risk out and think long term.
And the good news is, even with a correction that may or may not be around the corner, corrections are usually temporary.
100% always temporary. There's never been a time where we haven't eventually stabilized and recovered. I have a great quote here, Derek. You're going to love this. This is from Warren Buffett. He says, "It's never paid to bet against America. We come through things, but it's not always a smooth ride." Point being is if you think things are going to be bad, you're actually betting against America. No one has ever gotten wealthy betting against America.
That's true. And when you look at the history of the market, it's always gone up, even with those
eventually,
dips.
right?
Trevor, thank you so much for stopping by.
You bet.
Have a great weekend.
All right.
And in the meantime, as always, if you would like to connect with Trevor, you can visit ShakibaCapital.com.